Yeah, Mike. The system that I use, I'm constantly talking about it from a futures point of view, but it's got its origins in options. So I want to talk about options today and how to use it and give some examples. So hopefully people will appreciate that. It might be a little simplistic for the professional traders we have on the subscriptions, but I think nevertheless, it's something that even pros wouldn't mind being reminded of, hopefully. Anyway, are we live? Are we live, Mike? All right. I'm going to hope we're live. All right. Good morning. I'm Vince Lanci, and this is the Gold Fix. Today, we're going to talk about, as usual, we're going to talk about tradable levels in gold for active traders, which has been interesting to trade over the last several days. And we're going to talk about something that, kind of is near and dear to my heart, and I think would better serve people who want to play in markets like gold, which don't always give you the return that you want or the turnaround that you want for active traders in a day or two. Sometimes it takes as long as a month. And I want to discuss how to express these type of trades using options. And I say that because, well, let me get to my notes here, if I can read my own handwriting. Any of you who know me before the Gold Fix know that I've been described as an options expert or guru or whatever compliment you get. But to have a conversation with me about options and not be well-versed in the terminology, I can go down rabbit holes. So, I've written a paper on volatility and energy at UConn, a UConn published paper, and I have most of my experience. Mike kindly reminds people that I have 30 years of experience, and we all know that 30 years of experience doesn't necessarily mean you're good at what you do. But if there's one thing that I am good at, what that is not English. There's one thing I do know, it's options. And the risk management of options, the pros and cons of options, the way to express directional opinions on options, and the hidden value in options if you know how to, if you have someone or know how to manage the proper option structures to put on. But once you have done that work up front using options to express a directional opinion, you can set it and forget it, so to speak. So why don't we go right to what I want to talk about, which is options. Now, the last 3 days or so, we have been trading from an active point of view on VBS. Now, I want to just very briefly and quickly show you what I'm talking about. And why don't we just fill the whole screen up so we don't get distracted by Twitter, as fun as that is. Okay. Several days ago, why don't we start with a couple weeks ago, right? And this is why I wish I was doing options on this, but the subscription audience is not options based. But first, this is a signal. Now, we're not going to get into the why. That's proprietary. It's something I've worked on for 20 years. To be long on a weekly basis. Now, imagine had you just been long on a weekly basis up to here. You would not have been stopped out. But if you're doing it with futures, you would have lost some sleep at night. You would have had to actively manage stops. These are not things that I think active traders are uncomfortable with, but these are things that people who work for a living and want to participate in hedge fund type of strategies but don't want the stress of it, wish they could do. And so as a result, they turn a lot of their money over to people and trust their money to them. Well, I'm here to say you don't have to do that. I'm here to say that, sorry, it sounds very almost cheesy, but once you're taught how to do something, you can do it yourself. the key is having the discipline, putting in the work ahead of time, and then walking away and letting the law of large numbers work for you. So I'm not going to be on my script here, so I'll be jumping around. But the theme we're discussing today is options as an alternative tool to trading in markets that give you respectable levels to trade like gold, but don't always do what you want them to do in a day. So here's a weekly example. This got me bullish from a macro position, and yes, I was positioned for it, and I day traded around it. I would have been better off with options. Then most recently, those rectangles we'll come back to because those are examples of what we're talking about. Then most recently, on the 4-hour chart a couple days ago, those of you in the chat room saw that I got a signal here. Ignore the red lines. The only thing that matters here for this conversation, the Bollinger Band is not the system. It's just a signal so that you can see to get long. And I got long at 1288 and change. And I got out at 1297 on average. And then the market went sideways. So this was the market saying, volatility is taking a break. Then magically, and to my happiness, that day I actually got a daily. So we have a snowball higher. So if I would have just shut up and bought an options structure back when I got the weekly break, which was sometime in here, look at this ride we would have taken. The market would have went down. We wouldn't have cared. And here we are today. So before we get into actual levels for active traders today, because I have a position on myself, I am long after being, see, I've done 4 trades in 2 days in gold when all I really had to do was one trade and I could walk away and focus my time on other things. I bought in the 88 area. I sold in the 97 area. I bought in the 88 and change area again. I'm sorry. Yeah. I bought in the 98 area and sold in the 02 area. I bought in the 03 area and sold in the 02 area. And last night I bought in the 03 area, which is a little preemptive, looking for, and this is all system based, looking for 10 to 15. Now, that's pretty high maintenance stuff. And we're going to get into those levels and what you should do today or what you should look for. But I want to start out in a more educational way. Those of you that are professionals, bear with me. I think you'll get something out of this. Those of you that are new subscribers or investors looking to just add a little value to their portfolio that's not simply buy right situations, try and follow along with me here. Okay. As a wealth generator and risk mitigator, properly utilized options, 1, limit your risk. 2, are low maintenance. And 3, have the added benefit of bolstering returns through what professionals call skew, vol gamma, or if you were wearing a pocket protector, you would say stochastic processes of volatility. Now, what does that mean before I lose you? Professionals know that on top of limited risk, options offer a hidden kicker tied to skew. Now, those of you who listen to CNBC and learn about skew, you don't really, they're not really telling you the whole deal. It's just a soundbite for them. Skew determines fear and greed, just like the VIX used to. That's not true. I'm going to tell you what skew does. Skewness in an option. I'm not going to define skew right now in terms of what it looks like mathematically. We can do that another time. I'm happy to do that. The skewness of an option determines the extent to which it over or underperforms in a market move. So for digital purposes, an option that has positive skew, if the market moves in the direction that you bought it, not only will it go up because the market is moving in its favor, it will go up because volatility will expand. You see this a lot in the stock market. The stock market has what's called a put skew. So puts have a positive skew. When the market drops, the option values increase more almost geometrically compared to what you would expect. So for those of you who think that the world is a bell curve, it is not. And in the gold market, you have what's called a call skew, which means if you buy a call and that call goes and the market rallies, that call, which should on paper statistically make 20%, will make 30%. It will also lose 30% if we drop, but there are ways to mitigate that risk. The point is, if you understand this, it's I don't want to call it a secret or sound conspiratorial, but it's through the education of an investing public that seeks to mitigate its risk and participate in the returns that options are used. Now, why am I talking options? The system that I use is options based. It has its roots in 25 years of market making as a professional trader, trading gamma and other esoteric aspects. And I use it for directional trading. And when I trade managing money, I used it managing money for hedge funds, multi-billion-dollar hedge funds. And when I advise hedge funds, as I do now, I advise them if they have a desk that's very preoccupied, to just use options and walk away, and I'll call them up with their levels. So why don't we get into some real examples? As you can see, gold is rallying there. We're not going to take that off the screen, but I want to get into some real examples for you. And we don't need that. Right. Here's some real examples. Right. The first thing is, if you use options, okay, here we are. Now, this is a little bit small. I'm going to make this a little bit bigger for you. Maybe not that big. Okay, here's an example that I put together. There are many of these. But what I do want to open up is, bear with me, folks. Here we go. Okay. Now, admittedly, this is luck of the timing as well, but I want you to take a look at this here. All right. What we are looking at is this is not very professional as marketing goes, but trust me, the content is worth it. Here we go. This is what we need. All right. The time frame on your window right now is April 2016. Or is it October? No, it's October 2016. I am not organized today, but I do think you'll appreciate this. All right. So in October 2016, if you had bought on October 7th of 2016, the December 1350 call spread, or 1350 400 call spread. Actually, what we're looking at here is more of a butterfly. This is not an ideal trade, but this is a very low risk, very limited reward, but it's incredibly simple to understand. And we'll talk about that in the options program today. But if you have bought the the December 1350 1400 butterfly on October 7th and laid out 470, you could go to sleep at night. You spent $470. That's your risk. Okay. And if you liquidated, as we advised a client back then, sorry, I got to make a little room here. And here's the time frame in question. Here's the time. These seem alike. The time frame in question is here. Here's the time frame in question. Now, the time frame in question, the thing is, well, how did you know the market would do this? No, I did not know the market would do this little spike here. But what I did know from the system that I use, that the risk reward was there to be long the market. And because the client represented it with long options, it was a multi-billion-dollar fund dabbling in gold. They had much bigger fish to worry about, much bigger issues to worry about, looking at things like Brexit, retail stock portfolios, but it fit their profile. And so we gave them a butterfly, and that's what they used. And they made money on it. They made 125%, never risking more than $470. And here's the key, right? When you look at these type of strategies, and why don't we just read the notes that I have here, right? All right, so there's that. Now, here's another one. April 11th, 2017, buying, okay, a put butterfly. You're bearish, laying out $478. Selling that put butterfly a month later and making 161%. Now, the pros of options I've gone through. Your risk is limited. You can sleep at night. And if you understand the nuances of things like skew and these hidden kickers that can add to your returns, you can make a lot of money. The problem is, when do you do it? Because options are very timing oriented. You can't just go out and nakedly buy options. The system that I use, and I'm not selling anything here, except I'm just sharing a little information. I like doing this. The system I use originated in options. And so I'm coming full circle here and saying, when I get a signal, if I wasn't an active trader, if I was someone who wanted to sleep at night or wanted to focus my time on playing with my kids or managing other parts of my portfolio, options are the way to go. And the reason that they have a kicker is because of skew. And we're going to talk about that in the options show a little bit today as well. But not only, right, are these strategies low risk, reasonable reward, but they're replicable. They don't happen once in a blue moon. And they're replicable because, and I want to get to this now, I'm going to show you graphically why they're replicable. Because, and this is important, and this is key, and I learned this from Linda Raschke, a famous options trader or a famous volatility trader. Volatility is more predictable than price. Volatility is like an entity that inhales and exhales. And a graphic representation of this, although it's not always so symmetrical, is when the Bollinger Bands, which is just a tool for visualization, widen in opposite directions, that's volatility exhaling. I said opposite directions. They must go away from each other. And when they pinch, that's volatility inhaling. It's taking a breath before the next move. Much more predictable, much more reliable than price itself. And in fact, can be used to predict price, which brings us to the daily chart today. Here we have on my radar, starting here, that says to me, get ready. The market pinches, giving me the good risk reward. And now I have the signal that when those Bollinger Bands move in opposite directions, after three other signals that are not being discussed here that are proprietary, I know that it's very good chance that when volatility does expand, the direction the market goes in will be the direction it follows through for at least 1 to 3 bars. How often is this strategy profitable? 50% of the time. Why does that not matter? Because our edge isn't in being right 100% of the time. Our edge is in risking 1 to make 2. And more so, if you express it with options, your edge is in risking less than 1 to make 2. You can double your money, and as soon as the market negates a signal, you can get out without losing all of your money. Now, there's risks to options too, but you have to understand what they are. So my sales pitch today, even if you are an active trader or an opportunistic trader, and you trade all day long, whether it be Facebook or Apple or oil or stock indices, and you like gold and you want to trade gold, gold respects the numbers. If you're a technician, gold respects the numbers like every other market does. It just doesn't do it on the time basis that you want. What takes a day in the S&P takes a week in gold. And the reason I'm so excited about this is because it just doesn't happen that frequently in gold that I get these signals on short-term bases. Usually I get them on weeklies and monthlies because gold is a slow-moving asset. But gold, and you know, I always is a strong word. I frequently remind people, gold is a wealth preserver. But there is a change out there in the marketplace that I don't ascribe to, but I cannot ignore the fact that people are now looking at gold as a wealth creator. And, you know, it is a wealth creator for me because I trade it. I think gold can be a wealth creator if you trade it. If you're looking to invest in it, or by that, I mean, hold it for long periods of time. It's not a wealth creator, it's a wealth preserver. But it's starting to move around a lot. And you don't have to be a Gunlock or a Soros to make money in it. And you don't have to know anything except that what your risk is, what your reward is, and when you should be getting in. So why don't we talk about today's levels? Yesterday on the close, because this is day one, we're in day two, we're looking at spot gold here. Spot gold is trading $1 above the futures market, the futures market is February still. Now, you'll notice that. Now, those of you that are saying, oh, spot is trading above futures or cash trading above futures, this is not natural gas, folks. It doesn't mean anything. It just means some people squaring up positions. Okay, but right now, looking at the spot gold market, you can see that we're trading at 1308.95, which puts futures at 1307.95. Long at 1303, I'm nervous. And this is why, you know, based on this and conversations with an institutional investor that I work with, I'm thinking more about options again going forward, and not just for retail, but for institutional clientele, because I think be above 1303.70, as you'll see in a second, on a technical basis, not related to my system, this market could run 1310, 1315, which brings me to a phrase that I've used in the past many times. Gold hates the teens. So I'm looking to get out very soon. For example, I bought at 1303, and well, I bought in futures at 1303, and my stop in futures is 1294.60. So I'm risking 9. I should be risking 9 to make 18 or 14, but I'm going to be very careful today. I would love to let this run, but something tells me to be careful. We're going to end this quickly because the roadmap is due up, and I want to put up the technicals just so you can see. Numbers today, 1308, 1310, 1313, 1315. Anybody who has a position on should consider buying a call. A professional should consider selling a call and buying a put in the teens. Because when we get to 1315, it's either going to repel quickly or it's going to blow through at the 1330. If we get below 1297, again, look for this market to go in the 1270s. Anyway, I'm long, looking to get out and to keep my powder dry. The next trade I express in gold will probably be in an option spread. And I recommend you tune in at 2 o'clock to that effect. We're going to be discussing options a lot more. Sorry for the time. Stay with us for the AM roadmap and the big week ahead, the Super Bowl week, as Michael says. Cheers. This is Vince Lanci. Look for you in the chat. If not in the chat, on a delayed basis, you'll get my information on Twitter.